Option selling can be a lucrative strategy for traders and investors, but it comes with a significant amount of risk. Here are some tips for managing risk in option selling. 1. Know your risk tolerance. Before you start selling options, you need to be aware of your risk tolerance level. Determine how much risk you can afford to take and ensure that you don't exceed that level. 2. Understand the underlying security. To manage your risk, you need to have a good understanding of the underlying security that you're trading. Study the company's financials, look at its stock price history, and stay up to date with news that may impact its future prospects. 3. Use stop-loss orders. A stop-loss order is an order placed with a broker to sell a security when it reaches a certain price. By setting a stop-loss order, you can limit your losses if the underlying security moves against you. 4. Diversify your portfolio. Diversification is an essential part of managing risk in any trading strategy. Don't put all your eggs in one basket. Instead, spread your investments across different industries and companies. 5. Manage your position size. Don't overextend yourself by taking on too large of a position in any one option. Make sure that your position size is appropriate for your account size and risk tolerance. 6. Stay up to date with market conditions. Keep an eye on market conditions and news that could affect the underlying security or the broader market. Be prepared to adjust your strategy if conditions change. 7. Consider using option spreads. One way to limit your risk when selling options is to use option spreads. A spread involves selling one option and buying another, with a different strike price or expiration date. This can limit your potential losses, while still allowing you to profit from the option trade. Remember that options trading involves significant risk and is not suitable for all investors. Be sure to consult with a financial advisor or professional before making any investment decisions.